Bell rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
Is the market getting you down? You need the Forex Super Model Techno Shield. Now, if this looks remarkably like a normal dustbin lid, then that's your problem. Basically, put it above your head if the market's hammering you, to the side, to the floor, everywhere. This is your lethal weapon in protecting yourself against the markets. Right, so moving on. I am the senior trader and I've been asked to do a series of videos on how to trade the Forex Super Model. Part 1 is that you, which we've done. That was just a look at how we believe most people trade. And part 2, which is this one, is entitled We Want to Be Wrong. Right, so let's start. We want to be wrong. Now, that may seem a little bit odd for trading, but obviously that is initially. Right, so we want to be wrong initially. Now, the Forex Super Model can be summed up in one word. Well, it can be summed up in a lot of words, and you can probably think of some rude ones as well. But let's assume that the Forex Super Model, if I had to sum it up, FSM, Forex Super Model, I would sum it up with the word early. Early. Now the Forex Super Model has many attributes, but its main attribute that it highlights complex flows early. Now, as a trader, highlighting things early has importance. So this is where we're going to start then. So just rub this off a minute. Now, if we want to go long and we're a default trader, so that's long. Now, as I said, we have an entry and we have a TP, a take profit, and we have a stop. Stop. Now, if the market, after we've, so that's our entry, if the market starts to go our way, remember we're long, we want it to go up. Let's suppose we're talking about the euro dollar. Why not? So we've entered, it goes up, then and it hits our take profit, we're happy. So this is, as we said, was the happy zone. And if it goes goes down when we're long, we're not happy. Now, if we're short as a default trader, and we've got our entry, got a bit of elbow room here, then our TP, take profit, is down the bottom here, and our stop is at the top instead. So if it goes this way, we're happy, and if it goes this way, we're not happy. Right, and we've explained all the intricacies of that. That's standard default trading psychology, not psychiatry, psychology. Right, the Forex Super Model then, if we're trading it in the first phase, and there are phases to trading the Forex Super Model. First phase then, if we have an entry and we have a long entry, we want the market to go down. So this is what we want. We want, if we're long, we want the market to go down, and we don't want, so this is not happy. If it starts to go the way we want, not happy. But if we're sort of going for a long entry and it starts to go down more, this is our smug zone, we call it. We're smug. So likewise, if we're short and we've made an entry, so that's our entry, we want the market to go up, and if it goes down, we're not happy. So smug zone. So it's the exact opposite of the normal default trader, in other words. If we want to go long, you'd normally expect you to be happy if it starts going your way. We're not, we want it to go against us, but it's going to go against us in a specific way. Now, let's rub this off then. So it can be summed up then. So the default trader uses, you know, all these things like FOMO, fear of missing out, so they go long after it's had a breakout, maybe because the fear of missing out. We adjust the fear of missing out to FONM, FONMO. So this is the fear of not missing out. We want to miss out. It's good for us to miss out in phase one of trading the Forex Super Model. So when we're long, we want the market to go down, and when we're short, we want the market to go up initially. Now these are on day trades and short swing trades, short time. Not short as in short time trades, short time swing trades, right. So that's where we are there. This is a structure or an approach which works very nicely for day trades and short time frame swing trades over what, 1, 2, 3 days probably. So let's have a look then. So how do we do that? The first thing really, the easiest way to do it, but not the only way, it's more difficult and less efficient, but the easiest way to do it, and the way we do it, is we have two accounts. So we have two trading accounts. There's nothing wrong with that. We have two trading accounts. So we have a short trading account and a long trading account. Now I know for some of you funding and just one trading account is hard enough. So we're well aware of that. You don't have to have massive amounts of money in each account. We'll do another video on how you can get small accounts going, or two small accounts going, and by small, like, you know, well, what we're talking, £200 to £300, $200 to $300 we would qualify as small. So you could, you know, if you're really hard up, and that's not a criticism, but if you're really hard up, you could have two $200 or two £200 or euro accounts giving you, so for about £500, dollars, euros, whatever you want to use, you could just about get going. Ideally about 1,000 is about right. So anyway, let's assume you've managed to get two accounts. Now phase one then, so trading the Forex Super Model, would be to, once you've decided on, you know, Professor Code has given you the the go. He's decided what the flows are, and he's said maybe, I don't know, euro yen. Euro yen is a long. So a long trade we're looking for. Now remember, the Forex Super Model can be summed up in one word: early. So you're looking at the euro yen and you're saying, right, we want to go long, but we don't want to go long in the default way by just buying, say, a certain amount per point with a 20-point stop or whatever, and then taking our chances in the market. We don't want that. That's not the way we're going to work. So what we'd do is we'd say, let's suppose our standard trade is £1, £1, €1 per point. We'd go short in one account, in the short account, 1 unit or £1, and we'd also go long in the other account, the equivalent. Now this obviously gives us a perfect hedge. And then you're going to say, well, what's the point in doing that? You're not going to make anything. All you're doing is incurring two spreads. Very true, very true. So it's cost you money to do this, and you can say, well, why don't you just wait then? Why bother? And I'll tell you, there's a lot of reasons why you should bother to do this. And let me think of them. Now, the first reason is that once you're actually in the market, you can actually see what's going on. So if we were doing this long trade, we would basically just get in short and long, and we'd open the account up, and then we would only focus on our long account because we want to be long. So the short account's running in the background. We just forget about it effectively. We know what's there. It's just running in the background. Now, so we enter the market short and long on separate accounts, and we focus on our long account, which is here. So we're looking at the ups and downs of the long account. And remember, we want the long account in the initial phases to be wrong. So we're looking at our long trade and on the euro yen, and we want to go long, so we want it to go up. But really, as far as the modelling is concerned, we're looking for this to become increasingly in the red. So this would be a good outcome for us. So we're looking at the long account and it's deteriorating. Now normally that wouldn't be happy for a default trader. They'd be thinking, it's deteriorating, I'm wrong, I might get stopped out. We're not using stops, okay? We don't need to use stops because we're balanced, all right? The only thing you've got to watch out for, and this is a very, very minor risk initially, but you do have to watch out for, is that if your account isn't properly funded and you really get a big shift, you know, you're going to be hedged, but your broker may very kindly decide you haven't got enough margin in one account and shut your trade down for you. Now you don't want either one of these trades to be shut down unless you want to shut them down, because that will suddenly, if they shut down the short trade, suddenly you're naked trading on this side, on the positive side. So let's imagine there's a massive spike down in the euro yen, then this account is going to go quite nicely into the red, and then let's assume that you're not margin called on it, and so we just think, yeah, we've had a good hammering on that, and we're quite smug about that because it isn't really costing us a bean apart from the spreads, you understand. And we know, without even bothering to look at our short account, that it will be nicely in the blue. So that is phase one of trading the Forex Super Model. It's it's to be in the smug zone. We want to see our trade, which we were going to put on, we have put on both ways. We want it to deteriorate on the long account if we're long, and if Professor Code had suggested we wanted to short the euro yen, sorry, we'd want to see the market going up and basically knackering our short trade on the short, and we'd be focusing on the short account. And if as the euro yen went up, we'd be thinking, yeah, that's quite nice. That's our smug phase. We're happy. It's costing us just the spreads. Good. Now that's really where we're at for phase one. So what have we really said? We've said in the ideal world you need two accounts, one short and one long. If you can't have two accounts, for whatever reason you can't, well, let's assume you can't have two accounts. You can do this short and long thing, but you can't use the same time scale on the instrument. For example, you know, on my account they're called DFTs, daily future trades. If you buy a pound's worth of DFT euro yen and sell a pound's worth of DFT euro yen on the same account, the broker very nicely closes it all off for you, and you have no positions, because they think the way the system works, they think your account, you think you want to close your trades, and so all you end up doing is paying two spreads and having diddly squat on your account. So that is not helpful when we're trying to do this method. So the only way around that is you can do like a DFT on one, and maybe a 3 month contract on the euro yen on the other one. The problem with the 3 month one is it's going to be more costly because it's obviously longer, and therefore your spread will be higher. So, but you can at a push, if you're really stuffed and you can't get hold of two accounts, you can do it. Excuse me. Now, and you can start very small. Remember, we're talking, you're not going to be trading full complex moves where there's 7 pairs with multiple trades. Let's say we are running 38 trades at the moment. But this really, you do need big accounts for that, and they need to be well funded. Excuse me again. Right, so that's where we're at. So I'll leave you with that information. That's part 2. We want to be wrong, and part 3 will take it from there and show you how to progress from the smug zone to the next zone. Thank you very much.